Our next guest will give us his insights on holiday retail and the state of the consumer. Joining us now, Nate Forbes, managing partner of the Forbes Company, who owns, develops, and manages high-end shopping centers in Florida and Michigan. So the story that we get, Nate, is that you're okay. You're on the upper part of the K-shaped economy. Give us an idea of what you're seeing in your malls when it comes to the higher income consumer.
Yeah, you know what, Steve? The higher end's really held firm. And I think the scarcity of product on the higher end is what's driving retail sales. And those with the highest levels of income are continuing to shop. They're showing stability in the marketplace. They're showing a drive and a need to consume and invest in material pieces that will stay in their closet and really stand the test of time. So it's been very resilient.
I want to stop you, Nate, because this whole idea of not having enough product, what's going on with that? When in America did we never have enough product?
You know what? I think it's a balance between the retail brands and the stores. And I think some of it is done to increase prices. So you see a little bit of an upswing in driving an increase of prices, which a lot of that has been borne by the consumer. But it's not hurting brands like Chanel and Hermes that are not so widely distributed, Steve. And they really try to limit their distribution, and they try to create that scarcity. And that's what allows them to drive prices. And the consumers that follow those goods and collect those goods have to have them at any cost.
What can you tell us, Nate, because we had a nice conversation in the last hour, that luxury is not driven strictly by wealthy people, but also by aspirational people who want to trade up and want something nicer for themselves. What's happening with that cohort of shopper right now?
You know, I've said for years, the Gap shopper of today is the Gucci shopper of tomorrow. And I think that aspirational shopper really drives and really works hard and wants to spend a lot of their disposable income on having high-end product, whether that's product with labels or that's product that goes down the runway or tunnel walks. And they're really driven by the aspirational consumer that believes that if you follow the social media post and follow what's hot and what's new, that you're going to be with the latest trends. And that's what they're displaying today on their backs.
Nate, at the end of the day, you can talk retail all you want, but if you own a mall, you're a real estate guy. And if you're a real estate guy, you're a rates guy. So tell me about the outlook when it comes to debt and rates and how much all of that matters for you in terms of financings and refinancings.
No, I think it matters a lot, Steve. I mean, we watch the debt markets every day. And I think right now where we are with the short curve and the long curve, the 10-year curve, I think we'll be within a band of 50 to 75 basis points of that for the next couple years. I think you might see a couple ticks down in 2026. And I think all of those that have retail or residential or commercial coming due, we plan ahead, we look at our long-term debt expirations, and we try to finance within a band that will allow us to continue to reinvest in our assets, invest in our consumers, invest in our projects and properties to make sure we're at the highest end and the highest level of retail shopping centers across the country.
Nate, it's Robert Frank here. The word of the year in luxury seems to be experiences, with all this money shifted from things and status goods to experiences. I know you try to create experiences at all of your malls, but what I'm seeing when I talk to LVMH, Kering, Richemont, all the big luxury companies, is they want fewer stores, but they want big flagship stores that have cafes, they have special pieces, they have VIP rooms. They build these sort of fewer stores into luxury experiences. Ultimately, do you see that sort of smaller footprint by these luxury companies hurting malls like yours?
Well, I would tell you this. First of all, I think when luxury was coming out of COVID, luxury expanded beyond their boundaries. And now they're starting to peel that back. So they're looking, number one, at all the gateway cities where they can have freestanding flagship stores in downtown areas. Number two, they'll go to the best regional shopping centers outside of those areas as their next strategy for growth. So if you're in the top 50 shopping centers in America, brick and mortar shopping centers, not downtown areas, top 35 to 50, you're in a good spot, because those luxury consumers are depending less and less on department stores and more on creating their own experience in a way to touch the consumer, develop those relationships, and develop loyalty with their consumer base.